All right. I want to welcome everybody to our podcast or our webinar this morning on unlocking the wealth with self-directed IRAs in real estate. And the reality is there are a lot of people that have followed some of the advice of their financial advisors and have opened up an IRA, but they're not maximizing it to their best potential. So we are talking about unlocking the wealth within your self-directed IRAs. We've got several people on the call that I believe are experts in the field of both IRAs and taxes. And so, Larry, we'll start with you. Have you introduce yourself, and then we can go to our friends at Madison who are also experts in the IRA field, and you guys can introduce yourselves, and then we'll go ahead and get started.
Awesome. Awesome. Thanks for the opportunity, Shannon. And great to meet everyone. My name is Larry D. West III. I own a strategy and consulting firm here in Dallas, Fort Worth, but we work with clients all over. And the premise of what we do is tax strategy and tax planning. Because here's the reality: taxes tend to be your largest expense. And on the road to wealth, it's the thing that can eat up your wealth the fastest. And so we just like to work with our clients to help them figure out strategies and plans to help them hold on to more of that money. And of course, send less of it off to the government.
That sounds like everybody's dream, and nobody really likes the way the government is spending the money. That's for sure. But Nicole, why don't you guys introduce yourselves over at Madison and give us a little thumbnail sketch of what IRAs are about and what your guys' experience is?
Absolutely. So my name is Nicole Capurso. I am a part of our sponsors team at Madison Trust Company, and I am here with William Osborne.
Yep. Will Osborne. I'm an account executive with Madison Trust, and I've been with Madison for about 2 years now.
Yep. I'm going on 3 years in about, I think, 8 days. We're the veterans here at Madison Trust Company. But yes, we are the leading self-directed IRA custodian in the Northeast, and we help investors diversify their retirement portfolios into investments that they're passionate about. So I'd be happy to talk about it a little bit further in our
So
presentation.
let's go ahead and start by talking about why you hear everybody talk about an IRA, but some people might be unfamiliar with the self-directed IRA portion of that. What is the difference? If I just open up an IRA, I go to my traditional financial advisor and they help me open up an IRA. What do I have that's different than what you guys do over there at Madison?
So we allow our clients to invest in alternative assets, so anything other than the standard Wall Street products. So the big institutions like Schwab, Fidelity, you name it, they're in the business of buying and selling stocks, bonds, and mutual funds. So it's not in their best interest to hold alternatives, which includes real estate, syndication deals, private placements, promissory notes, and they don't have the administrative sort of capability, if you will. So we've taken on that burden. We fill that niche, and we allow our clients to, as I said, invest in alternative investments.
Awesome. Guys, today what we're going to talk about is the Capital City Growth Fund, projected returns that we have here, the use of the money as a debt fund. We're also going to deal with some tax strategies like UBIT tax avoidance strategies. That's very different than what most people think of when they think of not paying taxes. It's a tax avoidance strategy, not just tax evasion. So it's very good to note that. Then we're going to talk about backdoor Roth IRAs and what that is and how people can utilize that to create additional opportunities to have more of their funds available to them when it comes time to actually utilize those funds. We've obviously got a very lengthy confidentiality and disclaimer from our attorneys that basically says that we are simply providing information. This is not an offer to sell or a solicitation of an offer to purchase any securities. It may not be relied upon to evaluate the merits of an investment. Goes on to say other things, that the presentation is confidential and intended solely for the information of the persons of whom it's been delivered. So if you'd like a copy of that, be sure and send us an email. We'll get this disclaimer over to you. We always like to put that out there because we want to make sure that people understand this is an informational webinar and the information should be used to help you make decisions, but there is additional information you're going to want to make that final decision. Let's talk about the world of self-directed IRAs. Nicole, William, we'll let you guys tell us, where did IRAs come from and why are they so important? And what are some of the tax advantages that happen along with the different types of IRAs that there are?
Awesome. So as it says right on the screen, this is Madison Trust Company. We are a self-directed IRA custodian, and the A lot of investors that we work with, they are unaware of that they can utilize retirement money into the alternative investment space. So that is done through what is known as the self-directed IRA. It is a tax advantaged or tax deferred opportunity for investors to utilize in a traditional IRA account, Roth IRA account, SEP or simple account at Madison Trust. And as you can see on the screen, there is several investments that we can hold at Madison. The most popular is real estate. So it allows investors to take control of their financial freedom and invest into what they are passionate about.
Nicole, you mentioned a couple of different types of IRAs. Can you give us a little bit more breakdown on what they are, what some of the limitations are on that, so that we have our proper terminology before we dive deeper?
I can take that on if you want me to. Yeah, so for traditional IRAs, those are tax deferred accounts. So the contributions that you make to a traditional IRA is basically, what's the term here? It's tax deferred. So the amount that you contribute is basically deducted from your personal income, or taxable income rather, for that particular year. So that's the tax benefit for a traditional IRA. When you take a distribution in the future, then it's going to be taxed as ordinary income, the amount that you take out of the traditional IRA. A Roth IRA is it's what we call a tax-free account. You're taxed up front so that you can take a tax-free distribution later on down the road. So the contribution you make is not deducted from your personal income. But when you take a distribution, as I said, it is going to be tax-free, assuming it's a qualified distribution. In other words, the Roth account has not been, or rather has been in existence for at least 5 years. A SEP IRA is also a pre-tax account, similar to a traditional, but it's for self-employed individuals. You can always speak with your CPA about that. And simple IRA, pretty similar. It's an alternative to a 401k. Honestly, on our platform, we don't see too many simple IRAs.
Excellent. Thank you for that clarification. So when we look at that, how setting up a self-directed IRA and how Madison can help you do that. Let's say I've got an IRA, I've been funding it, and now I want to get into the world of self-directed IRAs. Run through that real quick for us. I know how easy it is because we just call you guys and you guys handle it, but that's not the real definition of it. What does it take to convert an IRA from a regular IRA to a self-directed?
So it's very simple. Of course, step one, you're going to need to open up your account with Madison first. Once that's established, it's going to depend on where the funds are coming from. So if it's coming from an existing IRA, the client fills out our transfer authorization form. We send that form to their custodian. They send the funds back to us. And that's just a change of custodianship of those funds. So there's no tax implications or penalties for doing that, for associated with that transaction. If they have a 401k with a former employer, those funds are eligible to be directly rolled over to Madison Trust. So same thing here, no tax implications. The process is a bit different. So the client will contact their plan administrator themselves. They'll provide Madison's delivery instructions to the plan admin. They'll send the funds to us, usually in the form of a check. But again, still no tax implications there, even if the client receives the check themselves. That check's going to be made out to Madison Trust.
Awesome.
Yeah.
So then once we've got the IRA open, the self-directed IRA, you fund your account, you make your investment choice, and then you guys are the intermediary that interacts with syndicators like ourselves that then make sure all the documentation is taken care of, make sure everything is accounted for, funds are transferred, and then we're in business, right?
And Shannon, that's exactly where my role comes into play here. I'm a part of our sponsors team where I work with investment sponsors such as yourself to streamline the service for investors. So we focus on three things: open, fund, invest. That last piece of investing is our favorite piece. It's where the clients can sit back, relax, and watch their retirement grow. So two things. We'll just need the investment documentation, which more than likely the investment sponsor will provide to the investor. And then we will need the client to complete the investment authorization form, which directs Madison Trust Company as to who we should be submitting the funds to.
Sounds much easier than most people think it is. And it's definitely been a pleasure to work with you guys as far as watching that process happen, because it is fairly seamless. So let's see. So let's let you guys talk about some of the different benefits of a self-directed IRA, because I believe these are your slides.
These are.
So,
I wanted to just backtrack to that disclaimer. Much like you, Shannon, we are also in a position where we cannot advise our investor bases to the different alternative investment opportunities that are out there. We do encourage each of our investors to really do their due diligence on the investments that they choose to place within their accounts. So yeah, let's get right into it. What are the benefits of a self-directed IRA? What is better than maximizing your earning potential of your retirement portfolio? Right there. First one up is portfolio diversification. A self-directed IRA can invest into investments that are completely off limits to what an investor can hold within a regular or conventional IRA. This opportunity with a self-directed IRA allows investors to invest beyond the stock market. So right there, you see it, hands-on investing. Typically, investors, they will rely on a broker or a financial advisor to choose the investments for them that they want to invest into with a standard IRA. This opportunity allows investors to go beyond that and really invest into, let's say, that fixer-upper down the street that you've had your eye on, real estate property. You can think about that. Think about your friend's startup company. That's the ability that a self-directed IRA can give each of the investors. And last but not least, stability. An investor can hedge against the volatility of the stock market and be able to have a more steadier revenue stream. They can take control over the assets that they like to hold within their retirement accounts. So that's pretty much the benefits of a self-directed IRA. I know the next slide we're going to talk a little bit more about the Madison Advantage. So what sets Madison Trust Company apart from the rest? As with any industry, there's some competition out there. So Will, can you just go into what sets us apart from the rest?
Sure. It's absolutely our customer support. So it's first class. I encourage you to check out our reviews online if you haven't already. They're exceptional, nearly 5 stars across the board. Thousands of clients have said so. And it's really our bread and butter. I'm on the sales side of the firm here. I talk to clients almost every day who are considering moving over from other custodians because the customer service really isn't cutting it. And the truth is, customer service is of the utmost importance with a self-directed IRA because we are executing all the transactions for our clients. It's still self-directed. We're doing everything with the client's direction. But if the custodian's not there, you're not going to place your investment in time. You're not going to pay an expense in time. So that, as I said, very important for customer service.
and let me jump in here just a minute too, because the reality is if you're looking at a traditional IRA, you're relying on your financial advisor, whether that's Schwab or somebody else, to make those investments for you. Most people don't pay attention to it. They select from a large list of mutual funds. They want some of this, they get some of that. And there's really not a lot that happens there between your investment advisor and the actual transactions themselves. That's always handled behind the scenes and behind the curtains. Where we are involved in fast-paced deals, we're raising funds, there's limited opportunity. It's very important on the customer service side that we can get a hold of you, that your client can get a hold of you, the documents can be executed, the communication can be had.
Exactly.
And the reality is it truly comes down in the self-directed world. It really comes down to customer service as the primary focus of what's going on. We all know that fees are there. People can charge different things. And the reality is, at the end of the day, if you're not getting the service, it really doesn't matter what you're paying or not paying. If you can't get your trades executed, if you can't get your funds out of your account.
Exactly.
And I'm here to tell you, not all IRA companies, self-directed IRA companies, are created equal, because we have actually spent on one occasion almost 3.5 weeks from the time that we started the process until we actually had funds wired. And it was not a rollover situation. This was someone who had been there for quite some time, but was now getting into more self-directed things. And it was an absolute nightmare.
Wow.
We have not had that experience with you guys for sure. And I won't name the name of the company, but we do not we do not recommend them.
Yeah, there's nothing worse than getting on the phone and not having a human talk to you, or being put on hold for hours and hours, and you just don't know when you're going to get an answer to a simple question.
And
then
that's
the
one of the
third-
things that you definitely want to make sure that you have is answers to your questions and the ability to get access to your funds. Because after all, let's not forget that even though the IRS does want to get their grubby hands on it, it's yours at this point. That's definitely something that we have seen with our interactions with Madison. And this is not a promo. This is just real live what we've done and how it's worked. If you guys are looking at it and you have a different IRA provider and you would like to talk with either Nicole or Will, here's their information. And I can tell you right now, if you call them, they will call you back.
Yeah.
So from there, let's jump into the overview of the Capital City Growth Fund. I want to start a little bit looking at some of the questions that were raised because I know Larry's on the call and Larry's our tax strategist. Some of the things that people look at, Larry, when they're looking at whether they use a traditional or a Roth or a simple, can you give us a little bit of a breakdown on what some of the reasonings behind it that you see with your clients that maybe want to use a traditional versus a Roth versus a simple before we go into what this fund looks like?
Yeah, absolutely. So when this conversation comes up, it really depends on their overall goals. And a lot of times it's going to be a progressive change in the type of accounts over time. Generally, we see clients that will start with the IRA, whether it's a traditional or a Roth, simply because those are individual retirement accounts. Then, as they take that evolution and grow into the business side of things, we'll see additional accounts come online, like the SEP IRA that was mentioned before, the simple, the self-directed solo 401ks, because those are specifically tied to the business. And so again, just depending on their objectives, we'll target one or the other. Now, when it comes to a traditional versus a Roth, that's when it really gets into the tax conversation. As they've outlined before, on the traditional side, those are what we call pre-tax dollars. That's, hey, our income thresholds are below, our income is below the threshold, and we want to get a tax deduction today. So when that happens, we go with the traditional contribution. That means we can reduce our tax liability today, but in the future, when we take that money out, we have to be prepared to pay taxes on it. And for some of us, we're already in higher income tax brackets. We know in the future that we're going to earn a little bit less or we'll be in the lower tax brackets. We bite the bullet and pay the tax today. And we use the Roth kind of a strategy where we'll pay the tax today, it grows tax-free over time, and then in the future, we get to take it out without tax implications at all. And so that's what really drives the decision of whether we go traditional or Roth on these type of accounts.
On one of the conversations that I have with people often, Larry, in this whole thing is, do you believe that the government is going to lower taxes in your lifetime? In my lifetime, according to Ronald Reagan, we had a higher tax thing going on in the 80s, but unfortunately, or fortunately, I was not in any tax bracket at that point. In fact, I was somebody's deduction. But the reality is you have to look at that and go, I heard the argument, I don't want to retire with a lesser lifestyle than I have now, which means I'm going to need to be receiving the same amount of money, which puts me in that same tax bracket. And the unfortunate thing is then you've got that decision to make is, do you get taxed now on a smaller amount or do you get taxed later on a larger amount? And there are some ways to avoid that or to mitigate that to some degree. But overall, IRAs are there for tax advantages. You just got to decide if you want those advantages today or tomorrow.
Mhm.
Yep.
Now, real quick, Larry, let's talk about some of the limits of what you can put into the different IRAs and how that works so that people can be aware of what kind of dollars they could be looking at if they were to start at an early age and continue this process for their working career.
Yep. So when it comes to the IRAs, the individual retirement accounts, as it stands right now, here in 2023, the limit that can go into those accounts are $6,000. And for those of us who are over 50, that goes up by an extra thousand. So now you're at the $7,000 threshold. So that's the limit that you can contribute to that account. Then when we get into the business style accounts, again, the SEP IRAs, SEP, or perhaps even the simple IRAs, those limits change a little bit and how you contribute to them change as well. So when we look at the simple IRA, for example, employees as the W-2 earner of the company, you can contribute up to $15,500 for 2023. That's the max that can go into those kind of accounts. But again, those are typically tied to the business, and then you're earning as a employee of the business and making a pre-tax contribution over there. When it comes to the SEP IRAs, those contribution limits change depending on whether or not you earn a W-2 or if you're what some people will call a Schedule C business owner. So if you earn a W-2, your contribution limit is up to 25% of the W-2 that you pay yourself from the company. You pay yourself $100,000 per a W-2, you can contribute up to $25,000. And there are some caps on that. The cap right now is up to $66,000. And again, that changes with inflation year in and year out.
Thanks for that. There's always more rules than any of us would like to know. That's why it's important, in my opinion, to work with people like Nicole, William, and Larry so that you can be aware of what your limits are so you're not caught doing something you shouldn't do, right? Let's take a minute and let's talk about what the Capital City Growth Fund is, the overview of the fund, and how that plays into the real estate landscape, and then how you can use that in your IRA. The reality is we've created a fund, and the use of the fund is for first position real estate and asset acquisition that is going to allow for flexibility. We do syndications all the time. That's a single purpose vehicle for a business plan. You get into the deal, you're in the deal until it's executed. We saw a lot of value in what we're seeing going on in the real estate market, some of the uncertainty that's happening. And we created the Capital City Growth Fund that allows for people to be more flexible. I hear a lot of people right now talking about, I don't know that I want to get involved in real estate. The market seems pretty tumultuous. Maybe I'll just leave my money in my bank account or in my IRA doing nothing. And so what we've created is we've created a fund that is in the lending space that is providing capital. And we've created that with a 7% preferred return and a 70-30 split back to the fund managers, which is us. And so that allows us to go out and do hard money lending in first position. It allows us to lend on free and clear assets that people have that allow for them to go and do the things that are necessary in their real estate business, and allows us to create a return. And the reality is that funds weren't necessarily as attractive 2 or 3 years ago. And Nicole and William, you can weigh in on this if you saw too many of those when interest rates were at 3%, money was almost free, and people weren't real interested in the flexibility of a fund. But we've seen in our capital stacks, we've seen preferred equity where you're getting a solid 7, 8, 9% return and a smaller portion of the upside. And then behind that comes the syndicated capital or the limited partners. There's different ways to stack your capital. The other thing that has been pretty prevalent 2 years ago was land loans. A lot of people would step into land loans. Banks would do that, 50 to 60% equity. But now when they're looking at the DSCR and they're looking at the combined income of the sponsor, it makes it more difficult for those to become possible. Not that land loans aren't viable. It's just that they're not possible at the lending rates that people were doing them at. So we've created a fund where we are on average between 12 and 15% on the funds that we loan. And I have personally vetted all the funds or all of the assets that we've invested in on this, because I want to make sure that if this asset does not perform and we are in a position where we are forced to take it back, it's an asset I like. It's something I believe in. We've underwritten it from the point of view of looking at the historical performance data of assets like it in the area, not just the asset in particular. And we've also put ourselves in a place where we have compared this to a traditional investment in that same market so that we can look at and go and ensure that we are getting higher short-term yields than we would get in other asset classes in the area, because then it doesn't really make sense to take a short-term position for a lesser rate than what is currently happening in that market. So one of the things that we've learned is the ability to leverage your money is really, especially in the self-directed space, is the responsibility is on you. And like I said earlier, a lot of people don't like what's going on in the real estate market right now. They're hesitant to take a long-term position. They want to do something short-term with their money. And that is where the debt funds become very practical, because a lot of funds, we are fluid in how we come into it and how we come out of it. There's not a real start point, there's not a real stop point. This fund can take on a life of its own and go for a long time, but you may only want to ride the train for a year or two. That is completely up to you. And it's a very easy process to get in and out of those. And that's one of the benefits of using a debt fund as an investment. So let's talk about how IRAs fit into this. First of all, Larry, let's talk about some of the benefits that a fund would provide to an investor, maybe that a syndication wouldn't, and then vice versa. Because I know we got a lot of people that come in and they say, hey, I'm invested in an IRA. I want to invest in your real estate syndication or your fund. What are the tax benefits behind that? Let's talk about tax benefits in IRAs and what you can and cannot get if you're invested in a syndication versus a debt fund.
Yeah, great question. So there are a few differences there. The first part of it, before we get into the structure of it, really comes down to the type of IRA vehicle that you're going to use. Again, whether it's traditional or Roth. Assuming that it's a traditional self-directed IRA that you're using to invest in either of these vehicles, the tax benefit that you really get to enjoy is all of the profitability, all of the earnings that come into that account. You don't have to claim on your taxes today. It goes into the account and it grows tax-free over time. That's the beauty of using the traditional IRA. Now, the downside is when you get to retirement age at whatever that happens to be, some of us after 59 and a half, all of those earnings, when we start to take it out, then we have to pay taxes on it. We have to pay ordinary income tax. Said on the other side of that, if we use a self-directed Roth IRA to invest in any of these vehicles, the assumption is post-tax dollars have gone into that account. So when the earnings happen, whether you're getting the interest from the debt fund or whether you're getting capital gains or rental income from the syndication, all of that grows tax-free. And at the point of retirement and you take it out, you get to take it out tax-free. So that's the beautiful part. That's the first place that we start. Do you want to do this with a traditional or a Roth? If you think you're going to be in a higher tax bracket and your investments are going to do exceptionally well, a Roth may start to make more sense than a traditional IRA. Now, outside of that, when you get into the details of the income that actually flow into the debt fund versus the syndication, a couple of the valuable things that you get with the syndication, it's usually a one-time project. It's one property, one acquisition. When that thing is over, you can either reinvest in another project or just have the earnings sit inside of the account. When you are inside of a fund, a debt fund specifically, you usually have a number of underlying assets, a number of underlying contracts that are earning at one particular time. And so the dollars are constantly reinvested. You don't get taxed on that money today, even as the earnings are coming in. Again, it grows tax-free over time. So that's really the beauty of using the retirement accounts is you get to grow your retirement chassis. It doesn't have to follow the traditional Wall Street model, and then you get tax-free income throughout the life of that investment.
Larry, then we talk about some of the tax savings that are available to people when they invest in a syndication. That usually takes the form of depreciation. There are some other tax advantages that can be combined with that. How does that relate when it comes to a fund or not necessarily a fund, I'm sorry, because a fund doesn't necessarily provide depreciation, but how does that relate when it comes to a self-directed IRA?
Yeah, so most people would believe that, hey, because I have an IRA and I'm not paying taxes on this money today, I don't need any of that depreciation, none of those negative K1s. I can just let that stuff go. The reality is, if you don't accumulate those negative K1s, using investor language here, then if and when that project sells in the future, when that syndication, when that multifamily or commercial asset sells, you could be looking at UBIT, which we'll get into here in a bit, which is unrelated business income tax. You didn't know your IRA would have to pay a tax? Yes, whenever there's an asset that was purchased with debt and then it produces income, you then have to pay a tax with your IRA. And so if you don't keep those negative K1s, quote unquote, and you don't file your 990 tax returns annually with your self-directed IRA, you could end up paying a UBIT tax, which could be a surprise because those tax rates rise pretty quickly.
So let me ask this question of Nicole and William. if I have a self-directed IRA and I'm involved in a syndication and we did use leverage and I did make money and now I have a UBIT tax, does my IRA look at that as something I can pay tax free? Can I take that out of my IRA? What is the standard protocol for the UBIT tax that I've now incurred?
So if the IRA owes UBIT tax, it's literally the IRA owing that tax. So it's not going to be the IRA owner who's paying that tax bill. It's the IRA. So the IRA owner, one of our clients, for example, they are going to work with their CPA to fill out the 990T. They send it back to Madison Trust. We countersign it, and then we send it back to them to send to the federal government so that they can, or their IRA rather, can pay that tax. We can create an EIN for them if needed for the 990T. That's no problem.
So when I pay that UBIT tax out of my IRA, let's just use the example that I put $100,000 into my IRA in a traditional sense, and now I have $1,000 in UBIT tax. When I go to take that out at retirement, does my IRA recognize the fact that I only have $99,000 invested, or does that UBIT tax get recognized against the profits that I made?
It won't. So when you take a distribution, as Larry and I stated earlier, it's still just going to be taxed as ordinary income. That UBIT tax that you paid maybe years before is not going to be considered.
I think we've hit this next topic of the explanation of unrelated UBIT tax or unrelated business income tax and some of the scenarios that you find. Do you guys know of any other scenarios that we haven't covered that may be something that someone would look at for UBIT tax in their IRA accounts?
Sure, yeah. So if someone is investing into an active business where the IRA is receiving ordinary income rather than passive income, and by the way, passive income would include rental income, capital gains, there are some exceptions there, interest, dividends from C Corps, that's all going to be exempt from UBIT. So for most IRA owners, this is not an issue. But if they're investing into an active business, let's say, I don't know, a grocery store, though, and it's structured as a pass-through entity like an LLC, that ordinary income, that business, that profit from an active business is coming back to the IRA, and the IRA needs to pay that UBIT tax, that unrelated business income tax.
I think that could sneak up on people. So it's definitely something to consider. But here we have structures and strategies to avoid UBIT tax. Larry, I think this is probably your question. How can we create strategies and structures that help us to avoid that UBIT tax?
Yeah, the best thing to do whenever you fall into this category, of course, is where we started a moment ago. Don't assume, and again, I'm going to use the term negative K1s. Don't assume that those don't have any value, because just as an individual, they would become suspended losses that you would use at some point in the future. Your IRA will want to use those suspended losses as well. So you want to make sure that every year that you're getting the K1, you share that with your tax professional. You either file the 990 annually, or you file the 990 in the year that you have the taxable income, so you can use those losses to help offset UBIT. The other thing to do is be very aware and cognizant of the type of alternative investments that you're investing in. Anything, again, that has debt as an underlying part of the capital stack or part of the acquisition, understand that there may be UBIT implications down the line. Because remember, these accounts were originally designed to be investment vehicles and to earn passive income or investment related income. That's interest, dividends, capital gains, different things like that. So you just want to be aware of the type of investments that you have there. And so that may be I'm going to say a small plug for something like a debt fund that typically earns investment related income. It earns interest, right? It earns dividends on the underlying notes or the underlying contracts that it has going out there. So those are two ways to really look at avoiding, or I should say limiting, your UBIT. And the other thing to consider is the IRA is a great investment vehicle, a self-directed investment vehicle, but there are also self-directed 401ks, which are considered trust accounts, and those are not subject to UBIT. So those are other vehicles to consider as well.
Okay, that's definitely a mouthful. Now let's talk about backdoor Roth IRAs. Nicole, William, you guys want to start this one off?
Sure. So my understanding is a backdoor Roth IRA is for individuals who don't qualify to make a contribution to an IRA. So let's say they have a 401k, they've accumulated over a number of years with their employer. Maybe they've left their employer. It's a pre-tax account. They can't make a contribution to a Roth IRA, but they can roll over those funds to a Roth IRA. So that's a rollover, not a contribution. So that's the backdoor part here. It's going straight from a pre-tax retirement account directly into a post-tax account. And of course, the applicable taxes will be owed. Custodians like Madison Trust, we take care of the complementary sort of reporting to make sure that's taken care of. But yeah, that's possible for individuals who just don't qualify due to their income.
We do have a Roth conversion form at Madison Trust Company, which can be easily accessed online. And it's just if they choose to go that route.
They could also just open up a traditional IRA with us and then just do the Roth conversion route rather than a backdoor IRA. But they're generally speaking the same. It's the same concept.
Yeah. So, Larry, what are some of the benefits of doing a Roth conversion or a backdoor Roth IRA?
Yeah, so the big benefit here is if you believe that, as you mentioned at the very beginning, Shannon, one, I don't want to retire making less income or in a lower tax bracket than I'm currently in. Most people don't want to downgrade lifestyle. And if you also believe that taxes are going to be higher in the future, having access to a Roth style vehicle allows your money to not only grow tax free, which is the point of the retirement accounts, but it allows you to take it out tax free. So the backdoor Roth basically says, hey, I'm not going to be penalized for earning income above a certain threshold. So now I have a vehicle or a backdoor way of actually getting to some long-term tax planning. So I'll contribute to the traditional, I'll do a conversion over to a Roth, and now my money is inside of this account and it grows tax-free over time. I think one of the best examples, and I believe it's Peter Thiel who did this with crypto a couple of years ago, $1 billion Roth IRA. How does someone who makes $1 billion have access to a vehicle like this when there are income thresholds? I'd imagine, I don't know this to be fact, but I'd imagine that he used a backdoor Roth strategy somewhere along the way where he converted money, did a self-directed contribution, a self-directed investment, and then it grew into $1 billion portfolio.
Yeah. And let's talk about how we can integrate that into real estate investments. One of the ways that we see that is somebody makes a $100,000 investment into a syndication. That is a very illiquid asset. Maybe they've made it into a industrial building that's a 10-year hold. And then they're looking at it every year. I get sent a valuation form from Madison Trust or whoever your custodian is. And I have to put down what that asset is worth today, what that is worth if you were to cash that in today. That value, obviously, because of its illiquidity, and especially if you're locked into something that maybe has a 6% preferred return, today's environment, we're looking at 8% as the interest rate, a 6% preferred return may not be looked at as something that is preferable. And we're able to put a value on that you can then take that value back to Madison, do a conversion from a traditional to a Roth, and do something like what Mr. Thiel did and allow yourself to convert that to a process that allows you to move funds from one place to another at different values based on their liquidity and based on market availability. So that is one way that we see the backdoor Roth IRA be of benefit to people in the syndication world. It's not so much the case with funds because funds are fairly liquid. They're tied up for very short periods of time, and they allow you to do that. Some of the tips that we can give people, and let's just everybody put one out there as far as a tip that people can use when using IRAs to invest with, and what are some of the better thought processes that people have had on how to use their self-directed IRA funds in the most advantageous way for them so that they can avoid the taxes. One of the things that I see is people do what Larry had complimented about or had a conversation about was involving your IRA to accumulate those passive losses, not for now, but because those do go on your balance sheet, or your tax returns, you can carry those forward. So at the time that you are regaining access to that capital and pulling it out after you've reached retirement age, you're able to then apply those losses to that and be able to take that tax free. Do you guys have some other tips and or precautions that people should look for when they're involving IRAs?
Yeah, you stole mine, Shannon. So I now
Well,
got to
it
come
was
up
easy.
with
It was low
another
hanging
one.
fruit, Larry. It was at the top of my mind because you made such a great and valid point about that.
I'll take it. I'll take it. So I think, and again, we're stopping short of giving any explicit advice, but I think everyone should consider having a Roth IRA as a part of the strategy, especially for higher income earners, because the reality is most of us do believe that taxes are going to go up, and most of us don't want to retire on income that's lower than where we currently are in life right now. And so with that, having a Roth as a part of your strategy, whether it's a backdoor Roth or just a conversion later on in life, I think may do folks a lot of justice because it grows tax free and it comes out tax free.
That's one
But
of the
then,
most popular IRA accounts at Madison Trust
Yeah, for sure.
Company is Roth's IRA accounts.
so what you're suggesting is that people pay the tax now, as ugly and as painful as that feels, so that they can enjoy it later without the taxes.
Yeah, that definitely has to be a part of the consideration because regardless of what people think, we are in one of the lowest tax environments that we've been in a long time. And it just may not be sustainable. Bite the bullet, pay the tax today so that you don't have to pay it tomorrow.
And Larry, as much as people don't want to hear, that is a very valid point that a lot of people need to hear. It's like my brother says all the time. If you really think that the government is going to lower their taxes, you probably ought to get your head checked because that's just not been their history. Yeah, my brother's quite the philosopher, as you could tell, but that's not been the history. And as much as it does not feel great to pay taxes now, there is some benefit to that and making sure that you've get that taken care of. So let's just recap a few of the main points of this webinar. Number one, you definitely want customer service if you're in the self-directed IRA world. A debt fund like ours is a great place to deploy your capital. You're able to experience the growth in your account during that time, and you're able to see some of the tax benefits that you would see along the way with that. Because if I understood Larry correctly, if I put $100,000 into my IRA and that IRA makes money, that money that I make is not going to be taxed. It's just the principal balance.
If you put it into the IRA and it grows over time, the growth on that 100,000 is not going to be taxed right away. If it's a traditional IRA, then you will pay taxes on that as you pull it out in the future. That's going to be considered ordinary income. So you'll pay taxes on the full thing, the 100 plus the growth, right? Because you got a tax deduction way back in the day when you put the 100 grand in there. If it's a Roth, then you don't pay taxes on the growth. And when you pull it out, you don't pay taxes on the growth at that point either, because that's the beauty of the Roth. It grows tax free.
And that's one thing that I think everybody should consider, especially if you're looking at being on the younger side of the investment crowd, because you have a long time for that to grow. I think the IRS would love for you to invest in a traditional as a very young person, let that grow for 40 years, and then they will be sitting there with fork and knife, ready to cut off their piece. But the thing is that people really need to understand the power of being able to invest in an environment that does not require you to think about the taxes from deal to deal. And if you're investing, whether it's in a syndication, whether it's in a fund, whether it's in any of these vehicles inside of an IRA, it allows you to have your full equity potential working for you at all times. If the deal sells, you don't have to worry about a 1031. You don't have to worry about paying taxes every time you get on and off the train. It's definitely something that allows you to grow in a tax deferred and sometimes tax free environment so that you can maximize what you're doing and have that full potential of that money working for you day in and day out, regardless of what kind of deal you're in, whether it's private equity, whether it's investing in business, whether it's investing in any of the different alternative assets. I want to say thank you to Nicole, William, and Larry for joining us. If you guys would like some more information on how to get in touch with any of these individuals, please contact us. We've got the Calendly link below. You can set up a quick call with Christy at our office, or you can go to shannonrobnett.com and get more information about us, Capital City Growth Fund, And we can connect you with these great professionals. If you didn't write down their information when we showed it briefly before, we can definitely connect you with them. So guys, thanks for showing up and sharing your expertise with all of us and the people that are watching this webinar. And any closing comments, guys?
Thank you so much for having us on. This was great. And Larry, thank you so much for talking about the tax implications and tax benefits of everything.
Yeah, thanks guys, and pleasure to meet you, Larry and Shannon.
I think you guys are just saying thank you because you didn't have to talk about the taxes. Nobody likes taxes, so we make Larry do it. Larry, it's always a pleasure to have you on, man.
Absolute pleasure. Thank you. I certainly appreciate it.